Americans are often considered the wealthiest people in world history, largely due to the fact that many of the world's richest individuals, such as Jeff Bezos, Elon Musk, and Bill Gates, are Americans. However, despite their relatively high incomes, many Americans are worried about their finances. This leads to questions about whether they are living beyond their means, relying on credit cards to make ends meet, and saving enough money for unexpected expenses. Even if someone doesn't earn a lot of money, it is possible to achieve financial stability. Investing in stocks is a viable option for the average person, but it's important to manage the associated risks. To answer these questions and achieve financial literacy, it's helpful to create a checklist of key considerations. Hello everyone, welcome to our YouTube channel, The Finance Professor, a channel dedicated to teaching our dear viewers about personal finance and effective money management. And in this video, we will learn about financial literacy from two of the most successful US entrepreneurs. Please stay tuned until the very end so you can benefit from the advice of the wise financial experts.
When you talk about the checklist of things that people need to understand to be considered financially literate, I think it delves into a number of categories. It numbers into your basic everyday financial living, the basics of debt, and understanding just sort of what credit card debt means, what mortgage debt means, what a car payment means, budgeting, understanding money in, money out. It's stuff that really sometimes can seem very basic, but clearly is not.
If you're not financially literate, then you have to worry about your spending. You have to worry if when you retire, you can meet your goals.
Income is where it all begins. Simply put, income is the money you receive in exchange for services or products. How do you generate income and how does it affect your life? When choosing a career, the law of comparative advantage is helpful. The theory of comparative advantage, which was popularized by political economist David Ricardo, introduces opportunity cost as a consideration when choosing between different options for production. So find out what you excel at and enjoy doing that is highly valued by others.
I've worked very hard and built a successful business, and I don't have to worry anymore in my life about your month-to-month bills and things like that. But that is true only because I did used to. I didn't have parents to give me money. I didn't have anything to fall back on. There wasn't a safety net. But what I did was rigorously plan and sort of set goals and then try to go about achieving them.
You don't have to own a business to think this way. Start thinking about how you can make yourself more valuable to potential employers, co-workers, and customers. How can you do your current job better, even if it is a minimum wage job, internship, or volunteer position? Are you working harder than others? First one there, last one to leave, not testing while on the job. These types of choices help differentiate you from others, and they create value for you in the job market. You don't necessarily have to be a business owner like David Benson or Jennifer Noon to think this way. Start pondering ways to increase your value to clients, colleagues, and potential employers. Even if it's a minimum wage job, an internship, or a volunteer position, how can you improve what you're doing now and perform more effectively? Are you putting in more effort than the others that you arrive first, stay late, and refrain from texting while at work? These decisions make you stand out from the competition and add value to you, the job market. Keep in mind that in the real world, you are compensated for the value that you create, not for your effort. And just as crucial as earning money is good money management. Spending, for example, represents the act of paying out money. How do you choose to spend the money you have made? Are you even aware of where your money goes? You'll be able to see where and how you're spending your money more clearly once you start managing your finances.
If I could only teach to young people today just one financial literacy skill, a necessity that people understand, is to construct their own financial budget and how they execute upon that. All I mean by this is to understand that there are fixed expenses. They have $3,000 that comes in and they have $2,500 of expenses. They need that fixed expenses, the stuff they have to, your rent, your car payment, your whatever the case may be. They need that number to be lower than what's coming in.
I think the easiest way is the 50-30-20 rule, which is 50% of your monthly income goes towards bills and housing. 30% goes towards finances, which is paying off debt or saving, and the final 20 goes towards entertainment or going out for things that you like to do.
So obviously the fixed have to come first, and you chip those away, and those get done, and then applying percentages to the rest. I think there's very little of that goes on. Some of the things that go wrong when one doesn't do it, and this is of course very common, you end up living your life in a way of you're always playing catch up. And it becomes very debilitating when someone gets behind. They may have the benefit of the consumption, then a new paycheck comes, a new bonus comes, and they don't get to enjoy the fruit of it because they're paying off the last toy that they purchased. And so you live behind instead of forward. I think that has a profound impact on one's stress level, but also just their capacity for the enjoyment of life. If people just started with that, the layering of financial priorities in their month-to-month cash flow planning, I think that would be the immense first step towards financial literacy.
Assets are things or resources either an individual or a company owns or controls. It generally is a useful thing like your savings, home, car, and other possessions that hold value. Saving is the first step towards building assets, and building assets is a skill that can be learned. Fortunately, this channel makes it easy to learn how to build assets and gain a better understanding of financial literacy. So please consider subscribing to the Finance Professor channel to know more about financial management and building wealth. Don't forget to hit the like, share, and bell notification buttons to avoid missing any of our videos.
The best reason I can offer for why even a high school student with a part-time job should start saving to some degree, just the habit. It's habit forming. That I believe that there is something to be said that for the merit of just getting in the practice of putting aside $5 a week, $10 a week, whatever the number may be.
I like to set up a savings account so I don't see that money, because if I see it, then I will spend it. So each paycheck, I take out a certain amount of money towards my bill for my car insurance at the end of the year, and it's automatically moved to the savings account.
You might consider money to be what everyone needs in order to pay bills, buy groceries, and attend to other everyday needs. All of this is true because we require money for us to function in our daily lives. Yet money has the potential to be more than that. It has the potential to be the key that unlocks the door to a better future. While it may be challenging for you to dream or set goals right now, if money has caused you issues in the past, you can start by thinking about a small goal. Setting aside a few dollars could be all that is necessary for you to avoid money shortages in times of unexpected expenses, like home and car repairs, medical emergencies, and other unwelcome costs.
So that your paycheck hits your account, and then automatically you have your bank account set to send from your checking account to your savings account, or just electronically off the top. You make your savings a fixed expense. It has to come straight out of your checking account. You're paying yourself first. And when that's in place, it opens up a lot of freedom to then go do other investment accounts.
Thanks to this strategy, you'll be able to live a life with little financial worry and stress. You'll be able to stay clear of financial problems and difficulties. Diversify your investments as you start to accumulate some savings. Always keep in mind not to put all of your eggs in one basket, because if just that one basket were to fall, well, you get the idea.
When you purchase a stock on the exchange, you're buying into a small piece of that company, so you're getting an interest in that company and you're becoming an owner of that company.
And it entitles you to the stream of profits that company hopefully will make in the future. It has risk because the company may not make it, so the stock market is a way of funding business in America that carries with it an appropriate level of risk and reward.
The best way for somebody to invest in the stock market with a small amount is by purchasing an index fund or an ETF or a mutual fund, because they are getting broad exposure to many different companies instead of just buying one position.
What exactly are mutual funds and index funds anyway? Managed by a professional fund manager, a mutual fund is an investment portfolio that collects money from different types of investors, including you, who want to diversify their portfolios. The simplest way to make sure all of those eggs aren't in one basket is by doing this. Similar to mutual funds, index funds, and exchange-traded funds, or ETFs, track the performance of a specific group of companies, such as a group of tech firms or a group of manufacturers of consumer goods.
Instead of picking individual stocks, I want to own Apple and I want to own Nike, they might just buy an index that includes a whole basket of these companies together. There's all kinds of different indexes and therefore index funds out there. The most common might be the S&P 500, representing sort of 500 major publicly traded US companies.
According to Investopedia, diversification is a technique that reduces risk by allocating investments across various financial instruments, industries, and other categories. With diversification, you can rest easy knowing that even if the value of one asset declines, it's likely that the value of other assets will rise.
But they want to make sure that the purpose of the money they're putting in is longer term money. The return of the stock market's been very good over time, but there's periods of time where it can be quite volatile. And so that's where one's financial literacy will hopefully lead to them understanding what instruments are good for short-term goals, what instruments are good for intermediate goals, and then longer term.
Compound interest is a powerful tool in your financial planning. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Compound interest allows you to earn interest on interest. You earn interest on all of the money you put in initially, on any additional funds you add later, as well as all on the interest which accumulates over time. As a result, you have a larger sum overall to earn interest in the future, spurring even further growth. The best way to take advantage of it is to start saving early and strategically invest once you have a real-world savings account set up.
Over the course of 20, 30 years of compounding, it's adding hundreds of thousands of dollars. I'm saying for regular middle-class families, the difference between starting to save at age 50 and starting to save at age 25 can be hundreds of thousands of dollars. And that's just simply from the benefit of time and allowing that money to work for them for a greater period of time.
Diversified stock holdings have produced a real rate of return of about 7% despite all recent and historical recessions and expansions. It's crucial to consider the rate of return in comparison to an asset earning 7%, which will double in value every 10 years. A 3% annual return asset will double in value in 25 years. There are opportunities for everyone who wants to invest in the stock market.
It makes such a difference when you can really exploit the time value of money, when you put time on your side. The leverage they get on that contribution to themselves because of the time value of money is monumental. And there's calculators that people can play with to go see, and they never believe the results. Simple interest would just work like this. You have $100, you earn 5%, you now have 105. And then you're gonna make another 5% on that 100. Now you have 110, the next year 115, the next year 120. So that 5% is simply being applied to your original $100. Compounding means that your $100 goes into 105 for the first year, but then 5% gets applied to 105. And let's say that number is 111, and then it gets applied to that. So the numbers start to break apart from the original denominator of the money. And so that's why compounding carries with it just a real special force mathematically. I think that there is really no financial literacy when people don't understand time value of money. I fundamentally believe that there's a key difference between buying something with credit that is an asset versus consuming something with credit. Okay, when you go to the pizza place with your friends and use money you don't have, you don't still have the pizza. It is really gone. Whereas when you buy a home, you are borrowing money, but you are purchasing an asset that retains some degree of value. And then assuming that the servicing of that debt, paying that person back with interest, is affordable, it enables you to buy a very expensive asset before you have to save for the whole amount. by being able to make a really sacrificial endeavor to save the down payment and take on an amount of debt that the service of which might even be less than they're paying in rent anyways, or maybe equal to it. Then they're building equity. The other example has always been, we talked about student debt, where you're taking on debt, you're gonna have to pay it off, but at least you're building an investment into a career, into a future, to education.
Your debts are considered liabilities. Additionally, the time value of money may be used against you. Many people experience financial difficulties as a result of their constant overspending, especially since credit is widely accessible right now. That has good and bad aspects. Its advantages because credit can increase your capacity to make alluring investments like a home or a college education. Borrowing, however, can be detrimental if you use it to pay for items that will soon lose their value. Travel on spring break with student loans, or only use the credit cards to the maximum to only pay the minimum amount you owed. When you spend irresponsibly more than you make, your wealth will decline and you'll have to pay a lot in interest on things you've already used up, which will make you more anxious about your finances.
As a general rule, paying for your vacations and your surfboards and your clothes shopping and your nights out with your friends with credit, well, clearly the asset is gone. You have zero of asset, but you still have the debit. So all you're doing is making yourself poorer by doing that. The avoidance of credit card debt early on is probably one of the great blessings a young person can ever give themselves. It's very debilitating to have to unwind significant credit card debt when you're really trying to get ahead and move forward in your adult life.
It's going to make you a lot less financially secure because you're going to have stress and have to worry about your interest rates going up from not being able to pay off those cards every month.
Someone could get to a point where they're literally spending over $1,000 a month and they're not chipping away at the debt at all. And I think that is what really ends up happening is you get used to the idea, I have a fixed expense of just making a credit card payment. I just paid $700, $800 a month for a credit card payment. And that could be a very high percentage of one's income. It ultimately leads to that kind of exasperation of feeling like you're never getting ahead. You get a raise, but you don't get to save or invest any of the money because you're still getting out from being, behind. The worst ramifications of excessive debt have always been emotional. They drain on people's joy. They add to their anxiety. But they take away hope. They take away from that feeling that you can move forward.
The money you earn is therefore your income. Earning money indeed has many advantages, so take advantage of all those earning opportunities. Save money to accumulate assets, create a financial plan, and only incur debt or spend money on things that will increase your assets or your capacity to earn money.
Most people don't need an education or know how to buy more pizza or go out with their friends more, but it takes education and it takes sacrifice, character traits, if one's going to really learn the practice of saving, goal setting, budgeting, things of that nature.
I think the biggest thing with people not knowing about the financial market or not knowing about a plan or saving, a budget, any of the things that we discussed today is because they are afraid that they'll sound stupid or they don't know anything about it, so just don't talk about it at all. But I think that's the worst thing you could do. The more you talk about things, the better you understand them. The more you know, the more you can share.
Personal finance is about achieving your own financial objectives. Following sound principles and developing them as a manner of living is the key to successful personal finance. Even with a modest income, you can feel secure in your financial situation. However, it will demand both planning and commitment. Create your strategy now and make the commitment to stick with it. You'll be grateful to your future self. That ends our video for today. We hope you found it interesting and insightful. Give the video a thumbs up if you liked it and also share so it can reach and educate as many people as possible about financial literacy. If you haven't already, consider subscribing to this channel, The Finance Professor. Stay tuned for our frequently updated finance videos that will help you become financially successful. Thanks, and I'll see you in the next video.